Good morning, everyone. Welcome to the Ashworth Wealth Weekly Market Update. My name is Todd McChesney. I'm a founding principal and senior wealth advisor here at Ashworth Wealth, filling in for James Rawlings, who's on vacation this week. So let's jump right into the slide this week and kind of give you an idea of what's going on. Number one, 10-year Treasury yields have climbed by about 38 basis points, which is 0.38%, to 3.8% in May. This is the highest level since the Silicon Valley Bank collapse. This is reflecting some market optimism, increasing growth, which means that the Fed may make some changes on some of their options going forward. Part of this relative strength in recent data is based on corporate earnings, and some of it's based on lower jobless claims and as well as consumer spending. Consumer spending is up about 0.8% month over month. Jobless claims last month were about 229,000, which was less than expected. And we also had a downward revision of the prior week's data. So things continue to look better from a market standpoint. That, along with some stabilization in regional bank deposit flows, which means that banks we're really not too concerned about a broader fallout in the banking sector. Having said that, that means that there's probably not going to be a bunch of rate cuts in 2023. I think we would probably expect one more rate increase to kind of help keep inflation in check. That continues to show some positive improvement there. And then after that, I would expect that at some point the economy may slow down a little bit. You may see some rate cuts to kind of get things going again. But at one point, they thought there might be as many as 3 rate cuts, and now we're looking at maybe only one before the end of the year, if any. So we'll kind of keep an eye on that and just see what's going on. Part of that, as you look at the chart here, you can see that as the Fed cuts rates, generally speaking, you can kind of see as the Fed cuts rates, short-term bond portfolios way outperform cash. And so one of the things that we want to kind of make sure as you're aware of as you're looking at your portfolio, if you're looking at situations, you're trying to figure out what's going on with my cash. Do I have too much cash? Should I be putting that in bonds? May not be a better time to put some of that cash to work, especially if it's something you might need in the next 1 to 2 years. Keep it in some short-term bonds. The rates are paying really well right now, and as interest rates come down in the near future, in the next year or two, you can see that the bond performance outperformance over cash is much greater than in typical times when the interest rates are going up. And so keep an eye on that. If you have any questions, please reach out to someone here at the office. Feel free to forward this to any friends or relatives or people that you may think might have some questions on what's going on in the economy. We're more than happy to sit down with them as well. And we'll close off or sign off for now, and we'll see you next week. Thank you.